Good morning. This is Bakes, Kevin Baker with Bakes Takes. Welcome to my podcast. This is for the week ending Sunday, September 27th. And we're taping this the day after the debates last night. And so it colors my commentary, mood, etc. But here we go. Let's get right into it. I wrote this prior to the debates. Trump likely to win, so buckle up. And I'll go into why I say that, and I don't take that lightly. Watch out for zombies. And lastly, COVID-19 vaccines. Buying the rumor and selling the news seems pretty likely. Let me take a step back. Driving over here in the wind and rain, frankly, was getting my blood pressure up after the debates last night. The commentary from both the right and left is when dumpster fire is the tame description of the event last night. It's problematic to say the least. So I'm going to take a deep breath. I recommend you do, and take a step back. This is an imperfect process. We scour the country of 340 million people. These are the two best people we came up with through a very flawed process to become the candidates for the presidential election. I have always said on the show and elsewhere that the impact and influence of the president is exaggerated dramatically. She simply doesn't impact our life directly all that much. It isn't zero, I understand that. But so I think we need to calm down a little bit and focus on, we're Americans. We get through everything, the good, the bad, and the ugly. It isn't pretty, and this certainly isn't going to be pretty, but I don't want us to lose our minds unduly, especially as investors, regarding what transpired last night and what might transpire in prior debates. At the end of the day, hug your kids, kiss your wife, love your mom, and it's all going to be fine. So let's just dial it down a lot, please. All right. First take, my/our portfolio. This is from the Wall Street Journal. It's an op-ed piece by Andy Kessler, and struck me. Clean power, no thanks to Al Gore. And this isn't going to be the political show. I put everything through the prism of how does it impact investments and ideas. So he's writing a headline to garner some attention. That's okay. I get it. But he also writes, nuclear energy took a leap toward being cost effective, yet the green lobby hasn't noticed. And he points out to one NuScale cluster. NuScale is a company that makes SMRs, small modular reactors, and points to their ability to put a cluster on 30 acres that replaces 11 square miles of solar panels. NuScale isn't alone. Bill Gates has reportedly invested $500 million or more in TerraPower, which started in 2006, was hoping to build SMRs in China before the Trump trade tensions put the kibosh on those plans. Mike, we've talked about that in prior shows with the excellent Netflix documentary that highlighted this. Bill Gates is thoughtful and his intent is positive, and those are my two assumptions. And the safety and footprint of today's nuclear reactor is a completely different animal than what he describes further in the article, which is nuclear needs a marketing makeover. Chernobyl was in the late 70s. The HBO series, regurgitated that horrific accident, but it needs some rebranding. How do we call it? Carbon-free heavy metals, maybe, or particle power, quark spark, anything but nukes, because these aren't your grandparents' nuclear reactors anymore. And as companies and countries reveal plans to be carbon-free, carbon neutral, etc., by certain dates, it's wind and solar that seems to get the attention, and nuclear doesn't seem to be on the same page. I think it should be. I'm also talking my book. I like uranium, which is why I'm bringing it up in this topic. He writes in the article, Joe Biden has promised to spend $2 trillion on clean energy. How much of that is nuclear? I don't know. I don't know if Andy knows or if it's been articulated in his platform or what have you. But so a lot of the climate change alarmists give nuclear short shrift. I think that is going to change, and that's the thrust of Andy's article, and I think it's a long-term positive for uranium, so please check it out. I leave a link in the show notes if you want to delve into this further. Next, fan mail. John from New Jersey asked about ETFs versus mutual funds, and I'll go into the structure first. Both are simply portfolios of stocks, portfolios of bonds, and then they have different mechanisms as to how you can invest in them and how they trade. By name, exchange traded fund means the portfolio trades on a stock exchange from 9:30 to 4 every single day. So there's a high, there's a low, there's close and volume. I like that because I like to read the charts. Mutual funds, by contrast, are simply priced at the end of the day, 4 o'clock, one snapshot, all the securities in the portfolio divided by the shares. You get NAV, net asset value, and you buy that the next day. So the only difference is that you could trade the ETFs intraday. That's basically the difference. Is there a mutual fund I like? Now, I prefer the ETF format for the reason I just said. I like the liquidity, and I like to see the chart patterns, which are more meaningful than simply seeing the final NAV at the end of the day in the case of mutual fund charts. Mutual fund I like? No, not really. Now, I haven't been looking for them because I've been focusing on ETFs and finding themes. I believe that stocks move in groups. There's a lot of academic evidence that shows that's the case, that you make most of your money by getting the group right, and stock selection is further down the list in order to garner great returns, i.e., if you latch onto the cloud computing theme, that's going to get you halfway home, and then picking the right cloud stock, Salesforce or otherwise, is largely secondary. So that's my view and my take. My next take is that FD, full disclosure, and algos, algorithms, and computer trading have made it very tough for active asset managers to outperform. And that's why people are flowing out of mutual funds and going into index funds, because for a lesser fee, you can get better performance. If you find one, John, that does so consistently, invest if it's in line with what you're trying to do. I want our themes, we call it SUV, silver, uranium, eSports, volatility, to be layered on top of an S&P index fund or an international index fund that hopefully you add to dollar cost average in your 401k, and we generate some extra performance by finding certain themes that we can exploit. So I hope that's been clear. Also, please, if you have ideas, services you'd like me to add, I encourage you to call in and email or tweet, whatever you want to do, so that I can incorporate them into the show and get better at what we do here. We'll go into John also talked about politics and how that influences things. I think that plays into some of the things I'm talking about down the road, but I'll get to that. So stay tuned. Podcasts of the week. This is Scott Galloway. He is the professor of marketing at NYU. I think very bright. I think funny. And this is his Prof G podcast. I'm pretty sure I have that right. And at 9 minutes or so, and what I like to do, to be full service, is I go through all the things that I listen to and read over the course of the week. I do this as if I'm talking to my sons, which I do all the time. And as I'm taking notes, I say, okay, if you want to get to the specific point, at 9 minutes or so, in this case, Scott talks about ACOM, a term that he has created for algorithmic commerce. And I find this fascinating, and I just think his thought process is unique, and I think it bears repeating here. When Walmart got involved in the TikTok discussions, I think we all scratched our heads and said, why is Walmart, a brick and mortar retailer, getting into this video service for kids? My description, probably not everybody's. And he makes a very good point of, by combining the Walmart logistics and retail experience with their online capabilities and the TikTok algorithm, that they can go for no-click ordering versus Amazon's one-click ordering that they've patented. And we're going to get to a point probably soon, in his opinion, and I think it makes some sense, that the akin to Netflix, Walmart will deliver to you not only what you order, but they will give you another box of things that they think you would like, and you probably will be delighted with them, and you'll keep the majority of them, and then in the third box, you'll send it back. So anticipating what you'd like from what you've already clicked on and viewed, I think it's going to be a fascinating thing to watch. I don't recommend Walmart stock. I don't recommend any stocks, but and I haven't followed Walmart closely, but I recommend the podcast, and I recommend Scott Galloway and following of that. In keeping, he has another podcast with Kara Swisher called Pivot. He talks about the same theme at 48 minutes on that this past week. And I just think it bears watching. And also, if it works, who is going to be replicating that in kind? And if you have investment ideas that play into this theme, I am all ears. So I really appreciate it. Next podcast, the James Altucher Show. I talk about him a fair amount. I'm a big fan. I listen to what he puts out weekly, almost wire to wire all the time. I certainly did in this case. This is with Jim McKelvey. He's the co-founder of Square and the vice chairman of the Federal Reserve of St. Louis. And what caught my attention here is Jim's company, Invisibly, which caters towards marketing for companies digitally. But clever digital poll taking is what I heard, my description, not his, because he segued into taking the same technology and techniques and applying it to 3 different Democratic primaries and getting all 3 right within a point. So then obviously the light bulb went off, and in 55 minutes he describes applying the same methodology to the national campaign, the presidency, and he has Trump winning. The traditional polls show Biden leading pretty meaningfully, and the stock market being up favors Trump. So this is his to lose with a month to go, no matter what you think of the debate last night. So I also had this conversation with John. I think politics are a peripheral influence on investing. I don't think you should do much of anything. I do think, as an American and as an investor, you should be ready for a Trump win that surprises people and from a societal standpoint, creates some uproar. Hopefully not more than an uproar, but I think that the conventional wisdom, Biden's leading, Trump's horrible, and Trump's going to lose. And I think there's evidence to suggest be prepared for an event that angers half of America. This is Altucher again with Philip Stutts. Go Big Media is his company, has a similar kind of a bent of advising companies on how to position themselves given what his polling suggests, what his digital marketing expertise points to. At 34 minutes, he says there is no new normal. I think that's right. So I think pining for that is going to be a waste of time. At 44 minutes in March, only 10% of Americans distrusted the government. That is now at 53 and probably climbing. So be wary of that. I don't have an investment implication, but I just found it interesting. But this goes again to the difference in the polls versus what he's seeing in the public polls. If you take the state by state standard polls, aggregate them. It has electoral votes, which are the only thing that matter that he points out. All the popular vote things, as Al Gore and Hillary Clinton will tell you, do not matter. So for electoral votes, the traditional polls suggest Biden has 353, Trump has 185 in the bank. You go to the prediction markets, which are the predictits of the world, where it's people betting with real money to assign probabilities of outcomes. Then they do that on a state-by-state basis and aggregate all of those. That suggests that Biden is at 290 electoral votes. Trump is at 248. You need 270 to win. For my Pennsylvania friends, and many of you out there, thank you. Pennsylvania is ground zero right now. And so if you're wondering why people are knocking on your door and calling you a lot, is that everybody knows that Pennsylvania is a big deal. If Trump wins Pennsylvania, he's got an 84% chance of winning the presidency. If Biden wins, he's got a 93% chance. So keep an eye on Pennsylvania. You're going to be getting a lot of attention in the next month or so. Florida, North Carolina, and Pennsylvania are very important for Trump. If he wins those, he gets reelected, according to Philip. I found this fascinating. According to his work, among African Americans, Trump has a 15% approval rating versus 8%. That surprised me. Maybe it does you. That was in 2016, so it's improved over the last 4 years. Hispanics in Florida are for Trump, especially Cubans. Pennsylvania and Wisconsin are going to be two key states for both candidates. Trump is using more door-to-door ground game, knocking on doors live to convince people. 1 million doors in Pennsylvania alone. Biden is almost exclusively using the phone. Now, that isn't a huge sway, but it's 1 to 2, maybe 3 points in certain situations. So, and then I wrote this before the debates. Fascinating debates. You might want to pick a different gerund. That's up to you. Or description. Turnout's going to be huge. 96% Democrats say they're going to turn out. 98% of Republicans say they're going to turn out. So it's likely going to be a record. And then going through the litany of things that impact opinion. A vaccine coming up. Trump is calling him for that. The economy, debates, the replacement for Ruth Bader Ginsburg, last-minute scandals. For example, the Access Hollywood debacle happened 3 weeks before the election in 2016. Woodward's book, and there must be a dozen others that are timing their release in the last 60 days before the election. Violence on the streets. With all of this, from what I've heard from these two out-of-the-box thinkers and with different techniques of assessing what voters are really going to do, Trump's going to win. And now, things can change, and there are no guarantees. But this also points to, and this is another podcast that I really enjoy, Adam and Dr. Drew, Adam Carolla, and he points to the trend towards participation trophies, that our kids can't be losers. And so that's kind of permeated things over the years. And I think that in either case, the election outcome will not be accepted by half the country. And you don't agree with me, Mike? No?
No, I do agree. I don't believe it's going to be accepted regardless of the outcome.
You know,
both sides will reject it.
So the thought process has been, Trump is creating uncertainty about mail-in ballots and what have you. But I think if Trump wins, even by a wide margin, I think Biden's going to challenge it because there's no downside. So that's why I think November 3rd is important. But then I think the ensuing days to January 20th are important. And I just get you ready for this because I think it's going to drag on for weeks. I think volatility has to increase. I'm amazed it hasn't done more so by now. But there's a lot of wood to chop. And last night sure as heck didn't help, in my opinion. It doesn't seem bullish to me. All right, let's go to Reporters of the Week. This is Barron's, Alexandra Scaggs. how to recognize the growing risk, the ranks of zombie companies. And this is the share of listed companies that are losing money and heavily indebted. The trend is not going well. And this is a longer-term chart. You know, when I talk about charts, I urge you to look at the time frame. This goes back to 85. And that is a pretty persistent trend, hitting new highs. And so before you invest in individual companies or individual themes, check out the balance sheets of the companies that you invest in, so that you don't get whacked, frankly. The next chart is a shorter-term chart. I noticed this on the drive over. This is from 2010, the market low. But companies with interest coverage less than 1, meaning they can't cover their interest payments, and it's breaking out. And so again, and what I do, I should have put it in the notes. You can go to Yahoo Finance and plug in a symbol, and you can look at interest coverage and debt ratios and things like that, just as a final check, so that you're not getting into a situation where maybe you think a dividend that a company is offering is safe, and it isn't, and dividend cuts really hurt stocks. But this, and then now this might be very energy centric. I don't really know, but it's an item that caught my attention, and I thought you ought to be aware of. The healthcare roundtable in Barron's I thought was fascinating, especially Lauren Rubin's article. And we've talked about Jeff Porges in the past. I've worked with him. He's on the sell side. I was on the buy side, and think he's very thoughtful. He is now with SVB Leerink, and he was also on the Barron's Roundtable TV show this weekend. And it was the most stark portrayal I've heard of expectations versus realities for vaccines. We've had a lot of questions on the show, Mike, about this. And but this is the first sentence that came out of the interview. We've spent a lot of time trying to figure out whether drug companies will make any profit from COVID-19 treatments or vaccines. Any profit. I thought, okay, it won't be the same margins as the rest of the business, but I never thought of it being break even across the board. And so the investment company has swung from the investment community has swung from thinking the virus would be a windfall for the pharma and biotech companies to more or less discounting the expected value of vaccines and therapeutics. I think that's out of consensus. I look at the ETFs, the XBI, and the other biotech ETFs, and I think expectations are somewhat elevated. And I didn't realize this. He points to Gilead has round tripped, and he talks about the forecasting assignment he has, which I don't envy. Don't know who the buyers of these products will be. Don't know what the prices will be. Don't know what the competitive landscape will look like, or even if the products will work. That's 4 pretty tough gauntlets to get through. So here's Gilead popping from the 60s to the 80s, coming back down to the 60s. And this might be happening in other areas of the COVID plays, if you will. And so I urge caution. He also talks about medical professionals that he talks to are profoundly skeptical about the basis of EUA approval, emergency use acceptance administration. I forget the exact acronym. But if you map out the timeline for a more general recommendation with adequate safety characterization, that doesn't happen till the second quarter of next year. And again, I don't think that's consensus. I think President Trump last night inferred there'd be a vaccine before the election. So I'm going to take Jeff's expertise and leanings on this with his bias or lack thereof versus President Trump's. And I think that we have to tamp down investor enthusiasm for COVID vaccines and therapeutics and societal economies opening up, getting back to normal expectations as well, given what I heard from Jeff over the weekend. So I think buy the rumor, selling the news is a bigger risk than many people believe. That's my take. Next, charts and tweets of the week. SPACs seem to be in the news every single day. There seems to be another company that is being acquired by a SPAC. And my thoughts here are that SPAC highs match stock market highs. I'm looking at the 07 bar here and the 2020 bar here. There are differences. There's no question about it. But when you go into bear markets, SPACs evaporate. So the fact that SPACs are hitting new highs and have been hitting since 2017 suggests that a level of froth. I'll just leave it at that. Some may be great, but some may be Nicola. And that fiasco unfolds every single day, and I don't think it would have if it weren't for the SPAC format. So not all SPACs are bad. Some SPACs are probably very good. They probably acquire companies thoughtfully, and it does bypass the IPO process. But the fact that they're so popular suggests that we're near stock market highs, not lows. The Bear Traps report this week, I think this is a great service. And I was surprised by the heavy amount of copper that's used in electric vehicles. Apparently much more so than in traditional combustion engine vehicles. And I just never thought of it before. 82 pounds in a car and what have you. And there's a lot of great expectations, and rightfully so, about what happens over the next 5 to 7 years in terms of electric vehicle sales. But the need for copper, at least, is going to increase in lockstep and may hinder some of those assumptions because of the availability. Over the last swoon in commodity prices, $3 trillion of CapEx have come out of the system. So their point, and I think I agree with them, is that the risk-reward in the commodity and resource space, looking out over the next 3 years, is pretty good. We see it in uranium, we see it in silver, and I'm looking at copper, especially CPER, that particular ETF, which looks the best to me to have an attractive setup as we go forward. I am not recommending it. I have not bought it, but it's on my list that I go through every single day, and I'm looking for copper. And again, I'd love to get your viewpoint. What are you seeing in the things that you read, the podcasts you listen to, that maybe I should include in the show? The next chart is the commodity supercycle, and this is the percentage of commodities in the stock market. And a lot of this is oil going from 140 to 40. But look at this. I mean, commodities are redheaded stepchildren in terms of the stock market right now. And there's no immediate catalyst for an abrupt turn or a spike to the upside. But whenever you get to something that's at a multi-year extreme, in this case going back to 1969, I pay attention, and my antenna are out for commodity themes that I should exploit, and I invite you to join with me and give me your input as well. For example, soybeans cropped up, and I try to read charts by covering the upper left so my bias doesn't come into the occasion. I don't do it all the time, and I don't do it as much as I probably should. But I know charts that where something new is happening, volume is picking up, and prices are going up. Soybeans have gone from 13.27 to 16 plus. Now they're consolidating. So it's an example of the kind of theme where there could be opportunities down the road. And again, I welcome your feedback as always. Okay, that's the show. Please also subscribe to my Bakes Takes YouTube channel. The audio is the same, but the charts that I reference are on the screen. Follow us on Twitter at @BakesTakes_ and other social media. Please use your voice memo app or tape a video and email to bakes@bakestakespodcast.com. Write if you prefer. I'll keep you anonymous if you'd like. Thank you for listening. Mike Wilson is my producer. Have a great week. This is Bakes. Much needed levity, and boy, we need some more levity. So I tripled up on the levity in the levity department this week. Anthony Jeselnik, this is from the Trump roast before he became a candidate. It was simply during the apprentice days, and yes, there's some salty language. You won't hear it on the podcast itself, but if you go to the link in his YouTube post, and it is very, very funny and mildly inappropriate, but very funny. Next, he appears on a podcast with Gregg Rosenthal, who is an NFL analyst, Erica Tamposi, an NFL producer, and they just have a great banter. It's funny. They recommend books and films, and it is I really recommend it highly. They just started up on a new one after Comedy Central didn't renew them, and they're at, I'm forgetting the new channel, but it's the Jeselnik Rosenthal Vanity Project, JRVP, and I recommend it. And then because of the loser trophy that I alluded to earlier, Christopher Titus has a great bit, and I recommend that as well. Have a great week. This is Bakes. Keep smiling. Take care. Bye-bye.